you probably already saw that before I even started mentioning it. But anytime I say a fair value gap that or an imbalance should stay open, what I'm saying is this. This is for your notes. If it's something that's acting as a premium array, meaning that it's trading up to it, which is the opposite of this, because we traded up and we're trading back down into it. The most sensitive area in that fair value gap is going to be the midpoint to the high of it here, which is this candle's low. So even if it did trade down into it, if I'm wrong about it not staying completely open and it trades down to the low, it matters not, because I'm going to get filled either at that candle's low or just above the consequent encroachment or midpoint between the candle's high here and the candle's low, so halfway in between. My fill will always be in that area. I am never trying to get a fill at the low end, because I've seen many times that the market won't go down there, or if it goes down there, it won't fill me because of the spread. So I'm not trying to frustrate myself. So I want to get in with the low-hanging fruit opportunities of entry, the low resistance barriers to entry. That means the easiest one that the spread won't be a factor for. I won't have to be perfect. I don't have to demand precision. Okay, to me, this is precise enough. Knowing that if I believe that this gap is going to stay open and have some measure of openness that's not completely filled in, what am I saying by default? I'm saying that halfway between this candle's low and this candle's high, halfway point, which is consequent encroachment, it's going to go no lower than one tick below consequent encroachment, meaning that I have to find a fill if I'm going to go long at that midpoint to this candle's low. There's nothing wrong with going one tick as your limit order above this candle's low also. That really assures that even if you just book this price low, chances are you're probably going to get a fill. Worst case scenario, if it goes one tick below it, then you should have no problem getting filled. But I've been in the market with real accounts with limit orders where the market has spread 2 ticks beyond my limit order and it still did not fill me and it ran without me. So it doesn't guarantee that you're going to get in, which is why I always try to use and teach low-hanging fruit objectives for targets, and the same thing happens for entries. We're looking for the lowest resistance or barrier to getting in trade. So if we believe that this is going to stay open, Caleb, where would you place your limit order to get in as a buy if you're trying to aim for this volume imbalance as I outlined before it traded there? Is it going to be you're using that low as your limit order, or are you going to use one tick above it and just feel comfortable with absorbing any of that extra drawdown, being willing to see it trade down to the low, because it could spike down there and do that and still trade up there? But your stop has to be below this candle's high. So the risk is defined by, okay, let's say it like this. Look at this value up here, okay, right above where I'm showing you my cursor. That low is 18,931 even. So your limit order could be 931.25. So if it books at 931 even on that candle, as soon as it does that, it should fill you. But it might not. That low comes in at 929 even. You're getting filled. You're literally giving it 5 ticks, or no, was it more than that? 31? 9 ticks. You got 9 ticks, 4 ticks makes up the handle. So it's 9 ticks traversing in price. So you're absolutely getting in there. So what is a low resistance barrier entry approach to using an institutional order flow entry drill? And that sounds like a whole lot of stuff. Sounds technical, doesn't it? Technical science. How about that, Anton Creel? We're not talking about technical science. You might not be talking about that over in Goldman Sachs, baby, but over here, it's technical science. Okay, but I can't believe he just talked about Anton. He's my hero. So this entry model here, you have to anticipate, expect, and welcome and afford yourself the amount of drawdown that could take place, because it could come down here and touch the low of that. But in my mind, because I've been doing it long enough, and you will discover this too over time, that the market is controlled algorithmically. And because of that, these types of events are true if you're correct And let's go back on that for a second. No matter how you trade, before you enter a trade, you have a religion. You have a faith-based model that what you're pressing the button on, you have faith that it's going to do something because you believe it will. Okay? I don't have blind faith. I have data. I have statistical probabilities that over 30 years, I've noticed these observations tend to be more apt to be correct than they're not. And I've transferred this information and logic and process and guidance to other people all around the world in different walks of life, and they are able to take this information and make money with it because it repeats. Okay, so if the markets are not algorithmic, then how do you explain that? These are very specific elements. Nobody, Chris Lord didn't talk about this. The guy he learned from doesn't talk about it. It's not in books. I mean, it's all on Amazon now with my name and logo all over it. You know, repeating everything I talked about in lectures, like this one. A lot of things I said in this one are going to be in books on Amazon. But it's probably going to be one of the better books because if they do it verbatim, you're going to have a really good psychological book. But that's it. He just gave me the permission to write a psychology book, ICT psychology. Whatever. The lower portion of that gap, I'm not interested in seeing it trade down there. But guess what I'm doing? I'm affording myself the flexibility. Should it do so, it would not freak me out if it's a day where I'm willing to be long. Okay, so Caleb needs to determine if he's going to use the low of that candle when there's a likelihood of a gap not filling and it trades down into it. Okay, the best fills are going to occur at the midpoint, which is consequent encroachment, to the high of that gap. And the least probable fill is going to be in the lower half because you're probably not going to get filled. Why? Because this gap formed after leaving this consolidation. So therefore, this gap should behave. It should behave as a breakaway gap. It's breaking away from this consolidation. See, but the folks that listen to me or watch what I do, they think it's either supply and demand because I'm drawing rectangles and over certain specific candles. And it's not supply and demand because supply and demand is a fucking myth unless we're talking about commodities, because that's a real thing. That's a grocery store of the world. There's real supply and demand factors in that market. But everything else is, it's not it's supply and demand. It's controlled. It's controlled. Now, I guess to some degree, commodities are controlled too, but there's real supply and demand factors with commodities. There's really no need to be buying a share of stock. There's really no need to be buying gold. It's a perceived form of money, but that's getting ready to be zero too. You know, when the Lord comes back, and I know you don't care to hear about this, but he's coming back soon. When he does, your silver and gold is going to be cast in the street because it's not going to save anybody. Wealthy people in the last days are not going to be comfortable. They're not. Okay, that's why I plan not to be here. So watch my personal YouTube channel if you want to know more about that. But this leaving of that consolidation, you're breaking away from that. If it's not supply and demand that people say I'm trading with, they're saying that I'm trading support and resistance. So if this is the resistance here, why didn't it come back down and touch it? Because it's not support and resistance that makes markets go up and down. The elements of this inefficiency, identifying it, as I mentioned in the live stream, you'll be able to record, not record, you'll be able to rewind the stream when it's done. When the sessions ended, within 5 minutes or so, usually I have to grab a drink or something. And then I'll go into the settings and I'll add it to the playlist for 2024 mentorship. If you have bookmarked the playlist, every day when the live stream's done, you can find that live stream that was made that day in the playlist in the order of their production. So that way you can go back and listen to everything and do all your note taking and whatnot. But the breakaway gaps, okay, when I'm referring to anything like this where it's not likely to fill, that's your key. That's your, like, okay, that means institutional order flow entry drill. Okay? Unless I say that this gap should stay open or unfilled, you're never looking at institutional order flow entry drill. That's not the go-to. Now, let me backpedal just a little bit for the folks that like this idea, because you might think, okay, well, I'm going to use that as my entry technique, and even if it's a fair value gap that I may not say I want to see it remain open. There's nothing wrong with that per se, if that's your entry model. if I'm building a position and say this gap is larger,
Order food you love.
if that's your entry model, if I'm building a position and say this gap is larger, okay, say it's a little bit wider, I will use institutional order flow entry drill as my first entry, 6 contracts long, and it may dig down into consequent encroachment or the upper quadrant, and then I'll add 4 more. And then if I really like what it's doing in there, or if we enter in between, like say it like this, say it goes in at 1047. Say this time was 1047. And then at 1049, it went down into consequent encroachment. And then at 1051, it trades down into 1 tick below consequent encroachment. I'll add 5 contracts on that one. Even though I'm underwater a little bit on the 6 contracts and underwater maybe a tick or 2 on the trade that I added 4 on, that'll be 10 contracts, then I can go with a 5 lot when it goes to 1 tick below consequent encroachment with the same assumptions that this lower portion is going to stay open. I've built in a position, okay? But what I just described, you won't be able to do that with one particular funded account company. Like you can't add, they call that averaging in. And it's just building your position. You can avoid that by just simply not doing this type of trading. Just do one entry, use your institutional order flow entry drill as your only entry, and then add your trade pyramiding in at a higher place.